Welcome to today's Explainer. We're going to be decoding the massive macroeconomic fallout of 2026, and more importantly, we'll look at how to actually protect your portfolio against the stickier inflation and global fragmentation that have followed. If you've been watching the markets lately, you know we're in completely uncharted territory. But the good news, with the right framework, there is a very clear path forward. Let's dive in. Before we map out a defensive strategy, we really have to ask ourselves a tough question about the true safety of cash right now. You see, when geopolitical shocks hit, our natural instinct is to just retreat to cash, right? But in a high inflation environment, that so-called safe haven might actually be a silent wealth destroyer. So let's look at exactly why that is and what we can do about it. Here is our roadmap for today. We'll start by diagnosing the global energy choke points. Then we'll weigh the costs of fragmentation, analyze this new inflationary regime, and finally, we'll build portfolio resilience by finding the hidden value in all this volatility. Let's kick things off with Section 1, Global Choke Points and Energy Shocks, and what is truly a historic supply disruption. It's incredible just how fast this crisis escalated. Within just weeks of the conflict intensifying in late February, we saw a full-blown blockade of the Strait of Hormuz. The International Energy Agency actually characterized this exact sequence of events as the largest supply disruption in the history of the global oil market. We're talking about an overnight, physical blockage, not a gradual shift. That led to a staggering 59% surge, with Brent crude prices jumping past $115 a barrel within a single month. To put that into perspective, that is a steeper and much faster spike than what global markets experienced during the 1990 Gulf War. Now, we aren't just talking about ordinary shipping lanes here. We are talking about a terrifying concentration of risk. The Strait of Hormuz is a narrow maritime bottleneck where 1/5 of the entire world's petroleum consumption and 20% of global liquefied natural gas transits. A single blockage there literally paralyzes the global energy circulatory system in an instant. And this kind of logjam, it immediately bleeds into absolutely everything else. It's not just gasoline we're talking about, it's agriculture and tech too. The Gulf produces roughly 45% of the world's sulfur, so when ships stop moving, fertilizer costs spike, which drives up global food prices. We even saw the threat of semiconductor manufacturing halting in Asia due to a 30% global shortage in Qatari helium. It's wild to think about, but a shortage of the exact same gas used in party balloons could literally stop advanced microchip manufacturing. These shockwaves touch every single corner of the modern economy. Moving on to Section 2, the costs of fragmentation and how we are navigating a second energy crisis. We're seeing a really stark trade-off right now as the world fragments. On one hand, surging treaty-backed military spending is becoming this dominant economic force. European defense stocks doubled in 2025, and spending is hitting multi-decade highs. But there's a flip side. This heavy militarization and massive investment in energy-intensive industries is actively crowding out the green transition. Research shows green patenting dropping by up to 25% following these kinds of defense shocks, simply because capital is urgently being redirected toward immediate domestic security. The immediate regional fallout has been brutal. With Qatari LNG declaring force majeure because their tankers couldn't leave the Gulf, we are witnessing a second major energy crisis in Europe. They entered the 2026 season with historically low gas storage, and as a result, regional gas benchmarks nearly doubled to over 60 euros per megawatt hour. It's essentially a perfect storm of low reserves colliding head-on with an unprecedented supply halt. That brings us to Section 3, a new inflationary regime, and why rolling shocks are essentially the new reality. You know that traditional 60-40 portfolio, the bedrock of investing for decades? Well, it's actually highly fragile right now. For years, investors relied on it because stocks and bonds usually moved in opposite directions. But when rolling inflation shocks hit, like the massive energy crisis we just covered, stocks and bonds suddenly become positively correlated, meaning they both go down together. It's a pretty brutal contrast when you break it down. While U.S. inflation has surged over 25% cumulatively this decade, core fixed income has barely moved 6%. Think about what that means. If you retreated to cash or core bonds thinking it was safe, you locked in a guaranteed loss of your purchasing power. Cash yields simply cannot outpace this new baseline inflation. It's becoming a silent wealth drag. All right, let's get into the solutions with Section 4, Portfolio Resilience and Real Assets, focusing on wealth preservation. So, how do we mitigate all these risks? You've got to expand beyond traditional stocks and bonds and get exposure to real assets. Commodities act as input prices, so they naturally rise with inflation. Global infrastructure offers long-term contractual cash flows. Gold has been an absolute powerhouse, surging roughly 130% over the last 3 years as a geopolitical hedge. And defense equities, they offer incredibly rare, decade-long revenue visibility because they are backed directly by sovereign balance sheets. This takes a really pragmatic, actionable approach. We aren't talking about abandoning your core portfolio, but rather building a vital inflation buffer around it. Analysts recommend allocating between 3 to 6% purely to gold and carving out up to 5% for real assets like global infrastructure and core real estate. This small, targeted allocation is specifically designed to act as a shock absorber when those traditional markets correlate and drop. Let's actually zero in on global infrastructure for a second. Historically, this asset class has delivered 8 to 12% annualized returns straight through various inflation regimes. And today, a massive 60% of that benchmark index is highly resilient power generation. Yet, despite these really compelling numbers, nearly 80% of surveyed family offices currently hold zero exposure to this class. It's a massive missed opportunity for inflation defense that's just hiding in plain sight. Finally, Section 5, Finding Value in Volatility and Tactical Strategies for 2026. Now, surprisingly enough, this global fragmentation actually benefits certain economies. While developed markets struggled under the weight of these shocks, emerging markets actually outperformed their developed peers by 11% last year. Why is that? Well, because many of them have robust debt-to-GDP ratios, higher real interest rates, and crucial oil reserves that provide a natural buffer during commodity spikes. We're also seeing a massive thematic shift toward what analysts are calling national champions. Because governments across the globe are intentionally sacrificing economic efficiency in favor of domestic security, they're pouring capital right into local supply chains. Investing in these domestic champions, whether that's in strategic manufacturing, tech, or defense, offers long-term investors revenue visibility locked in by state treaties that can literally extend out a decade. Active management strategies are also uniquely positioned to survive these chaotic hiking cycles. Just look at macro hedge funds. During the massive dual market drawdown of 2022, they actually delivered a 9% return by capitalizing on volatility. Yet, just like with infrastructure, they remain drastically underutilized. The data shows that 94% of private bank clients currently hold absolutely zero exposure to hedge funds. The big takeaway here? Don't let the scary headlines dictate your timeline. By maintaining flexibility, preserving your liquidity, and focusing strictly on credit fundamentals, we can actually view these episodic macro shocks as a gift. They are entry points to buy discounted, high-quality assets that have just been temporarily dragged down by broader market panic. As we wrap up today's explainer, I want to leave you with a really vital question. Are you still relying on an outdated 60-40 playbook built for a seamless pre-2020 world? Or are you prepared to build real resilience into your wealth plan today? The map has fundamentally changed, the inflation regime has shifted, and your portfolio needs to reflect the reality of this new frontier. Thanks so much for exploring this with me, and I'll see you in the next explainer.